Do you want to make better retirement tax decisions? Well, in this video today, we're going to talk about 8 specific years inside of your retirement tax plan that you need to be focusing on in order to make better decisions. There are going to be certain years where you want to show higher income, potentially pay a little bit more in taxes. There are also going to be certain years where you really want to control that income and pay less in taxes. We're going to show you which is which and help you optimize your tax situation along the way. Let's get into it. Now, before getting into these specific tax years, I want to make sure we understand an important foundational concept that we're going to be carrying through for the rest of the video. Now, a lot of retirees I see make mistakes right from the start that end up messing up their tax decisions. And the main error here is focusing on the wrong tax number. So I see a lot of retirees focusing on something called your effective tax rate. Now, you find your effective tax rate by taking the amount that you paid in taxes and then divide that by the total income that you took. So if you paid $10,000 in taxes off $100,000 worth of income, you have a 10% effective tax rate. Now, generally speaking, your effective tax rate will almost always be lower in retirement. You earn a higher standard deduction. You can start to manage your tax situation in a way where you can take from more tax advantaged assets, and you're really only taking the amount of income that you're ultimately going to spend. We're not taking excess income that we need to save because, well, we're in retirement. And so your effective tax rate will oftentimes be lower in retirement. And so because of this, I find a lot of retirees don't do a ton of tax planning because their effective tax rate is already lower than it was while working. But this effective tax rate number really has no decision-making power, and so it really doesn't make that much sense to focus on this number. Instead, you should be focusing on a tax number called the marginal tax rate. And what your marginal tax rate will show is at each given level of additional income that you take, what is the tax rate that we are paying on that additional income? On the x-axis, you'll look at income you would take from ordinary income tax sources. On the y-axis, you'll see the marginal tax rate that you would be paying at that given level worth of income. Now on the screen, I have a tax graph for somebody who is on Social Security, and this red dot right here is showing the amount of income they would take from their traditional IRAs. Now at this red dot, if they took roughly around $60,000 worth of income, their effective tax rate would be 9.7%, as we just showed in that previous example. But yet we see right off the bat, looking at this marginal tax rate table, areas where they can start to save on taxes. For instance, the last $10,000 of income that they took from those traditional IRAs, they paid over $4,500 in taxes. And you can see why by looking at the tax spike on the graph. For the most part of the last $10,000 of income that they took, they were paying a marginal rate of 49.95% because of some various tax hurdles that were stacking on top of each other. And so this is the tax graph that you ultimately want to look at to make better tax decisions. And in order to make better tax decisions, we need to be asking 3 basic questions. What does our marginal tax table look like right now, this year, in order to make those tax decisions? What does our marginal tax table look like in the future years? And then, will I have better opportunities to save on taxes? So for instance, if the marginal taxes that you would be paying right now are very high, at some point in the future they'll be much lower, well then we have better opportunities to save on taxes later in retirement. And so we'd rather show less in taxes today in order to save on taxes later on. If we flip that situation and we were in some low marginal brackets right now, we are going to see higher marginal spikes moving through time, and we don't really have that many opportunities to save on taxes, well then we might want to show higher income through Roth conversions in order to save on taxes later. Now, just so we have some consistency, I'm going to be using a case study that we take through the rest of this video, through all of those 8 tax years. Know that we're going to be loosely following this couple's situation and understand that your situation might look drastically different based on some different planning elements that you have. What I'm trying to do here is not necessarily show that everyone's situation is going to look exactly like this, but rather give some examples that you can take back to your given situation. So to tell you a little bit about this given couple, they were retiring in 2022. Their last year of work was 2021. They're going to be on 1 year of ACA insurance before going on to Medicare. They have some pretty large IRA balances, and so RMDs, required minimum distributions down the road, will be a concern for this situation. They're currently living in North Carolina, but planning to move to Florida in 2022 once they retire. And they have no pension, but the husband does have a fairly large Social Security benefit. The spouse is going to be taking half of that Social Security benefit. Now, the first year that everyone should start looking at inside of their tax plan is their baseline year, which is generally this year. Science teaches us that anytime we're making a decision, we need to start with our control. Well, our baseline is our control. Now, for this specific situation, we're actually going to be looking at the last year that this couple was working, 2021, and remembering that they're planning on moving when they retire to another state that has no income tax. They currently have a state income tax here. So we see that in the last year of working, they were making $168,000 living in North Carolina. And this is what their tax table would look like showing that much income. I have highlighted on the screen the $168,000 mark. And what you'll notice is that puts them right inside of the 22% bracket. But their marginal rate based on the add-on for state income tax is actually 27.3%. So this might be surprising to a lot of you, but in their situation, we're going to find as we start moving through these tax years that we essentially want to show more income anytime we're at a marginal rate lower than 25%. Now, 25% is quite a high marginal rate, especially as we just showed that effective tax rates can be quite low in retirement. Why would we want to be showing more income or performing things like Roth conversions anytime we're at a marginal rate lower than 25%? Well, you'll see as we move further into this video. So something to keep in mind as we show additional tax years here is we are trying to take all future tax tables and try to look at them in terms of current dollars. And so we're leaving out inflation and trying to discount back to current dollars to just help with understanding certain marks and certain things within the tax code. Now, the next tax year that I recommend looking at is any year that you have a large expected spike in income. Now, this could come for a couple different reasons. For this couple's specific situation, we're looking at the example of selling an investment property with $130,000 of capital gains. So they previously had rental assets that they no longer want to carry into retirement based on the amount of work and complexity that it would require them in retirement. Now, this tax graph ends up looking a little bit wonky because always remember your capital gains stacks on top of any normally taxed ordinary income. And so as this person starts to show any ordinary income, they're going to be moving more of those capital gains into being taxed at 15%. And so their ordinary income is technically still going to be underneath that standard deduction, but they have that 15% marginal rate. And so we can see that they can show about $25,000 worth of income, let's say in the form of a Roth conversion, and still only pay a 15% marginal rate. But then once we're past that mark, we can see that once we start stacking on ordinary income rates, with the spike that they would have because of adding in those capital gain rates, they're taxed at 25%, 27%, then back down to 22% for a little range. And then once they're subject to the net investment income tax of 3.8% as an added capital gains tax, we'll see that they're back to being taxed at 25.8% for quite a while. So for this specific tax year, again, remembering that they ideally want to be converting and showing additional income anytime that they're underneath a 25% marginal rate, we can see that they want to be converting at 15%. They potentially even want to move up and convert at 25% here. But then once we're past that, they really want to stop those given conversions. The next tax year that we recommend looking at is the last year that you work. Now, in this couple's situation, this is going to be the same as the baseline year we originally looked at. So we're going to skip over looking at this. Now, many of you can probably guess the next year we want to look at as an important tax year. We just looked at the last year they were working. We now want to look at the first year that they're retired. Now, most people would assume, again, once you're retired, there's a lot more room for paying lower taxes. Again, your effective tax rate should be lower as we discussed earlier. But remember, this couple is going on to ACA insurance. And so there are all these tax hurdles that can raise your marginal rate. And that's exactly what we're going to see in this first year of retirement. When they're on ACA insurance, the amount that they report for income will determine how much they're paying for their healthcare premium. If they end up reporting a very low income, they can earn a very large subsidy. Unsubsidized health insurance might be $1,500 per month for this specific couple. If they show a low enough income, they could theoretically have their health insurance at a $0 per month premium. So that's a pretty large benefit that they can gain by showing lower income. Now, this is what their tax graph looks like then as they start to report additional income. They'll start to lose that subsidy. And when we translate that into their marginal rate, we can see that it really spikes their marginal rate. Now, moving into this year, despite no longer working, there was still a bonus that was paid out that will be counted in this year's income. Now, what we'll see then with the $20,000 worth of bonus in the background is what their tax graph currently looks like as they start to show additional income. And we could start to see here that as soon as they start to move into that 10% bracket, their marginal rate is actually going to be 17% based on the amount of subsidy that is lost. This ramps all the way up to a 37% marginal rate before dropping back down into some lower marginal rates. Again, this is because of the guidelines laid out in the American Rescue Plan that fades out certain subsidies based on the amount of income you show relative to the federal poverty level. But we can see here by looking at their marginal tax graph, it leads to different decisions than we otherwise would have thought. Tax year number 5 that we recommend looking at is once you're on Medicare, but you have yet to take Social Security. This is generally thought of as the Goldilocks zone in tax planning for retirement. The reason being is because with most tax hurdles, surprisingly, you're actually hit with those tax hurdles at lower income levels. It's not the large income levels where you start to show those additional tax bumps. There are some tax hurdles that start to hit you at those higher levels, but a lot of the retirement tax hurdles that we start to see are actually at lower income levels, surprisingly. For instance, when we looked at ACA insurance in that last slide, we saw that you really couldn't show that much income before starting to lose that given subsidy and seeing those marginal spikes. Now, if you aren't on ACA insurance, you have healthcare through the government and things like that, that might also be a Goldilocks zone. But really, it's this Medicare zone prior to filing for Social Security that opens up another Goldilocks zone in tax planning. And the reason being, as you can see on the screen, is we can show income and be taxed underneath the standard deduction at 0%. We're then taxed at the normal 10%, 12%, 22%, and 24% rates. Now, I am showing $7,000 in forced capital gains or dividend income here, just to show a couple of ripples within the tax graph and show some complexities that you still need to be factoring in. But on the screen here, we can see that this person can show quite a bit of income in the form of Roth conversions and still be paying those lower marginal rates. Now, keep in mind, this is before the Tax Cuts and Jobs Act expires. So in 2026, we're going back to the old rates prior to the Tax Cuts and Jobs Act, which means there's a portion of the standard deduction that fades out, and then we're going to see most brackets rise by 2 to 4%. So this is a zone where we have some things working for us. We're on Medicare, so we need to be thinking about IRMA, those Medicare premium increases, as we show additional income down the line. But we're still underneath the Tax Cuts and Jobs Act as well, and we don't have those high tax hurdles that are affecting us at those lower income rates. And so this person would certainly want to be maxing out the 22% bracket, probably even going to the far end of that IRMA zone past the 22% bracket, moving into the 24% bracket. And then from there, we need to start making decisions. Obviously, you see another spike down the road there at 27.8% because of that net investment income tax. And then each of those IRMA zones also needs to be translated to a tax rate. Now, while this couple is on Medicare and still has yet to file for Social Security, they're going to be moving past the Tax Cuts and Jobs Act. And on the screen, I have an update of what this graph looks like once the Tax Cuts and Jobs Act expires. And now you'll see it still makes sense to show some income, but we're going to be paying some higher rates as we start to show that same amount of income. For instance, now we see the 0% bracket, the 10%, the 12 turns into the 15. We see the 27 turns into the 30 in this red spike zone that we see from the capital gain bump zone. We see the 22% bracket then turns into the 25% bracket. We then see the 24 turns into the 28, the 32 turns into the 33. The 33 actually moves up a little bit, and you're subject to it at lower incomes as well. And so once we actually move past the Tax Cuts and Jobs Act window, now we probably want to start controlling that income where we don't show over a given IRMA zone. Again, we need to be factoring that IRMA expense into a given tax rate. Typically, that works out to anywhere from a 3 to 6% marginal spike. And so if we're paying 25% and we have a 3 to 6% marginal spike, well, now we're starting to pay rates higher where, again, there were additional opportunities a little bit earlier while we were still working. Tax year number 6 that you look at is one of the most important, and this would be once you are finally on Social Security. Now, again, your optimal filing date may change based on what's going on in your situation. For this couple, we had the husband delaying until 70, and the spouse was taking a spousal benefit based off the higher earner's benefit. And so we see that the large benefit with a spousal benefit in current dollars translates to about a $68,000 benefit. Now, understand with Social Security that it creates a tax hurdle called the Social Security tax torpedo. We talk about this a ton on our channel because it's one that so many retirees face. And what we'll see here and why there's a marginal spike is because the amount of Social Security benefit that you have that is taxed is determined by your other taxable income. And so what happens here is as you're taking a dollar from other taxable income sources, it's forcing more of your Social Security benefit into being taxed. And so we have a double taxation effect that's happening. We pull a dollar and we have a $1.50 or a $1.85 that is ultimately being taxed. And so we see marginal spikes because of that. You'll notice this marginal spike zone ends once our Social Security benefit is fully taxed. And so what we see here with $68,000 in current dollars of a Social Security benefit, we can see that they can still show additional income and they will have some of their Social Security benefit be taxed, but it's all underneath the standard deduction. And so they can show about $10,000 to $15,000 worth of income that we see on the graph here. Then once they're in the 10% federal income bracket, because of that double taxation effect, they're moved up to 18.5%, then 27.75% when they're in the 15% bracket. And then we see the highest marginal spike here, 46.25%. Keep in mind, we're looking at this after the Tax Cuts and Jobs Act. And so we're looking at the underlying brackets being 15%, 25%, 28%, and so on. Now, factoring in their basic living expenses, healthcare, as well as taxes, they need to show a gross income a little bit over $90,000. Now, if we look at taking additional income from taxable income sources, this would put them right in the middle of that 27.75% marginal rate zone. Now, finding themselves in this zone isn't the end of the world. At the end of the day, they're just moving into this zone based on their current tax tables. And depending on if they still have very large IRA balances, they might not have that many options in order to take from other accounts. Now, if they performed a lot of Roth conversions prior to this, then there might be some withdrawal optimization where the last $10,000 worth of income they might want to actually show in form of capital gains or show in the form of Roth withdrawals. But again, this isn't the end of the world with their given tax situation. They're in a fine tax situation from 70 until 72. And once they turn 72, this is when they start to move into a worse tax situation due to, well, required minimum distributions. Now, this leads us into what I think is one of the most important tax years for retirees to look at, and that's tax year number 7, which is the first year that RMDs begin. And then you could also add on tax year 7B, which is the year that they max out. And based on this person's situation, we see that RMDs are quite large. If they don't do anything in the form of Roth conversions or optimizing their withdrawal order prior to RMDs beginning, we can see based on their long-term income graph that RMDs are set to be pushing right above their income need, which means that they're simply losing money to taxes. This is very tax inefficient. Essentially what's happening is they're showing more income than they need. They're being pushed into higher brackets and tax hurdles because of this, and they're only losing dollars to Uncle Sam that could otherwise stay within their tax situation. Now, we'll see on the screen that their first RMD in the median simulation of the 1,000 simulations we ran for their situation is about $83,000. Now, if I discount this for inflation using about a 3% inflation rate, we find that the current RMD they would be showing based on the current tax tables would now move them beyond this Social Security tax torpedo. Now, just to show some added complexities here, I'm also showing some forced capital gains that will add into this given tax hurdle. You'll see that spike of that marginal rate move from 46.25% because of the capital gain bump zone, and then the Social Security tax torpedo on top of that capital gain bump zone. You'll see that rises to 55.6%. Now, unfortunately, this is creating a situation where they're just past that marginal spike zone, which means they're paying all of the higher taxes of that torpedo. Now, the good news here is they still have some room if they find themselves in this given situation. They still have some room for additional conversions. Once they're past this spike zone, their Social Security benefit is fully taxed, and we really see there are no other spikes that they will be facing. And so they could be maxing out the IRMA bracket, which would lead to about another $50,000 to $60,000 worth of conversion room, which should lower future RMDs. And so understand that you still have options once you're on RMDs, but it can get a lot more difficult. For instance, if their first RMD made them fall right in the middle of that Social Security tax torpedo, now decisions get a little bit more difficult because if they show additional income in the form of a Roth conversion, well, now they'll show additional income in those higher marginal spike zones. Finally, the last tax year that we're going to look at, and this is more of an uncertain year. We know this year is going to come, but we don't know when this year is going to come. And this is specifically for married filers, and that's the loss of a spouse. And so we've talked quite a bit on the Safeguard Wealth Management YouTube channel around something called the widow penalty. Essentially what happens with the widow penalty is oftentimes you still have just as high of income. Again, that spouse generally inherits a lot of those IRA accounts. And so they have a very similar RMD, if not the same RMD, but now they have half as much room in each tax bracket. They have half as much room in each IRMA bracket as well. So what we oftentimes see when one spouse passes away, that surviving spouse has a tax hike because of having half as much room in each of those given tax rate zones. We see that they are moved far beyond the Social Security tax torpedo right off the bat with that beginning RMD, and they also see numerous IRMA spikes as they start to show additional RMDs as well. So there you have it. If you know what these 8 tax years look like for your situation, I promise it will lead to better tax decisions, which ultimately leads to you saving significantly on taxes. Now, anytime I show a lot of these given graphs, I'm oftentimes asked in the comments, what software packages do you guys use? And the software package that generates a lot of these given graphs is called Holistaplan. Now, that being said, understand that you still need to overlay quite a bit of knowledge in order to utilize these tax graphs properly. For instance, if you put me in a Formula One car, I certainly still will not be able to keep up with Formula One drivers. There are still skills and knowledge that need to be overlaid on top of the tools that are being used to make those better decisions. Now, if you're looking at a lot of these tax graphs and they seem fairly complex and you're wondering, should I just perform one giant mega Roth conversion rather than trying to make all of these complex tax decisions each and every year? Well, don't worry, we have you covered. There's a video right here that we recorded talking about whether a mega Roth conversion ever makes sense. I think the conclusion from this video might be surprising if you found value out of this video right here. Thanks for watching, and always remember, you don't need more money, you need a better plan. Look forward to seeing you in the next video.